Welcome back to our Monetary Policy Special. I've been speaking with SBI Chairman Dinesh, Khara, former MPC member and IIM Kozhikode Professor, Mridul, Saggar, Samiran Chakraborty of Citi and Neeraj, Gambhir, the Group Executive Treasury and Wholesale Banking at Axis Bank. Gentlemen, thank you for staying on with us. Mridul, when is the next cut, you think?
I don't think this will happen in this fiscal, probably into the next fiscal. I would be rather surprised, but it all depends on how much is the seasonal correction in food prices. So if food prices surprise down, such a thing did happen in the past 2 years. But if it surprises on the down and there's room, obviously the central bank would like to take it. But I think there is too much sort of disruption going on for us to believe that food prices would fall significantly, because there are other elements which are coming up, even if tomato corrects.
Okay, so do you think that April would even be considered by the government, because we would have a lame duck, sorry, not government, by the RBI, we would have a lame duck government. There is a reasonable possibility that ahead of the general election, some kind of income transfer schemes are announced. I mean, last time the NDA returned with 330 seats. Even then we had a Garib Kalyan Yojana, 6,000 rupees being given to every farmer family. So income transfers is par for the course in an election year. Do you think therefore April is tough? Lame duck government, why not wait for the first full budget? Won't the MPC think that way? Mridul?
I think it ought to think that way. It would be a vote on account. We won't have clarity on what the government is doing really. So the central bank would also probably be in the same dilemma. So I think there's case to hold the rates unless we see growth significantly fall or inflation being well anchored, inflation and inflation expectations. Then there's obviously a rate cut case. But fact remains that in this hiking cycle, we didn't go far. You look at how other central banks have raised the rates. There's a big difference between what the RBI did and what most central banks did. And inflation remained high, but not significantly high in this duration.
That's a fair point. So not a very high hiking cycle, and therefore possibly a delayed and shallow cutting cycle as well. Samiran, your best guess? First cut?
I mean, we've discussed some of the points, but one aspect also is that by April next year, we should start seeing the global growth numbers being cut down more aggressively. In Citi, we expect the 2023 growth to be about 2.4%, but the 2024 growth to be only 1.6% global. Now, that sort of a backdrop might suddenly change the tone of the discussion and make the April rate cut also possible. Although we have acknowledged that given this inflation bump and uncertainty that we are seeing, the risks of it getting delayed further have increased. I think the other key aspect would also be that to what extent, as we were discussing a while back, the RBI would be comfortable in hiking rates in a quarter where their own, if the actual forecast materialize, actual inflation is averaging 5.2%. Is that going to be a good enough quarter for them to consider rate cuts?
Yeah, absolutely. Going into April policy, all you have is a February number, which is more likely to be 5 plus. Would you really have the courage to cut or even the justification? Neeraj, what is the range you think the 10-year moves from now to December? And if I can push your courage, even the fourth quarter, I mean, would you think that we have enough upsides?
No, I think we're dealing with a whole host of uncertainties here, both domestically as well as globally. Besides inflation, there is crude oil prices, there is geopolitical risk, there is what Fed does next and at what point in time. So I think for now the market is well anchored between 7 to 7.25. I would say about 7.15 to 7.35. But if any of these, variables go in the opposite direction and the inflation does surprise us on the upside, I think the market will possibly inch towards 7.5. So that's not my base case. I think I'm looking at about 10-15 basis point volatility for now, depending upon how the overall macro environment plays out.
So 7.1 to 7.3, you're saying?
Yeah.
Okay, that's very rangy, really, if it's only that much.
It has been quite rangy for quite some time, actually.
Yeah, absolutely. I mean, more so the rupee, which is why I'm sacrificing that question so as to get to the growth question to Mr. Khara. So how is the demand for loans? I mean, even now it is like the capex cycle is going to recover. People are not speaking in terms of a gush of projects, and liquidity is still reasonably comfortable. So do you see a great demand for loans that can push up yields?
Well, I think different segments of the economy, there is definitely visibility of the demand. It may differ from various segments, but I would say that broad-based, universally, demand is very much there. Corporate, we have started seeing some positive trends in terms of the new projects where people are showing interest. In any case, the new growth levers like renewable, etc., there is a scope for further lending. SME, we are seeing very clear demand coming in. Likewise, even in retail as well as in rural, there is a very clear visibility of demand. So I think it's there, but is it at the peak level? I think we'll have to wait and watch. But nevertheless, there is a very clear visibility.
What I heard from the smaller banks is that there is undercutting by the bigger banks when it comes to lending, that they force us, to give better rates because they are ready to cut. So it didn't look like the yields were going up in terms of the cost of capital. But Mr. Khara, what about this complaint over home loans? The governor almost seemed to say that by elongating the home loan EMIs every time the rates go up, the banks are even camouflaging possible default cases because you don't want the EMI to rise and therefore be faced with the potential default. Is this going to be a tricky one? When the rules come, we don't know what the rules are.
No, of course, there is a system to engage with the borrowers and explain to them both the situations and eventually go by what their options are. This is normally the practice which is followed by banks like ours. But I would not be in a position to comment about the practices being followed by various other banks.
Okay. Fine. Finally, I wanted to ask you this, but this perhaps not really policy related, but a very interesting public tech platform that they are talking about, where they are able to give, at the moment it's a pilot for Kisan credit cards or Kisan loans, which is end-to-end digitized. You must be an important participant in this pilot. Are you getting a sense that we are going to have much better credit evaluation, much faster credit? Is this? Can you tell us anything about this project?
I think when it comes to it would be faster credit dispensation. Evaluation will be incorporated into the decision engine will be there in the loan management system itself. So evaluation as it is will be more standardized, I would say. But yes, of course, dispensation, credit dispensation would be much faster. So it's moreover, it will ensure much better convenience and much better underwriting and also frictionless delivery.
I'm asking you because if it succeeds in Kisan credit cards, what the governor seemed to indicate is that it can be stretched out for all small loans, end-to-end digitized. So do you think there is a a very serious possibility, a good possibility of the bottom of the pyramid getting a lot more loans?
Yeah, it is. In fact, that is the intent when this particular project is being tried out. And of course, the outcomes of the project will be evaluated very carefully, and thereafter scaling up, of course, would require some bit of a time also, so that all the ecosystem players should be on board on this.
Okay, well, those are the small things that RBI always drops in the monetary policy, the interesting things which make the economy much more productive, increase productivity. But those discussions for another day. It's been a pleasure speaking to all of you, Mr. Khara, Neeraj, Samiran and Mridul Saggar. Thank you very much for giving us more understanding about the economy and the monetary policy. Welcome to a monetary policy special. The Reserve Bank kept the repo rate and the policy stance unchanged as expected. And the governor sounded even-handed between dovish and hawkish tones. Let's first hear him out.
The recent spike in CPI inflation is expected to be short-lived, going by past trends. In such situations, we need to remain watchful and not resort to any knee-jerk reactions. Now, if these spikes, these idiosyncrasies in CPI inflation, particularly food inflation in particular, shows signs of getting generalized, then we may have to act.
That's as even-handed as it gets. However, one could say there were two unexpected elements which could be termed hawkish. One, the Reserve Bank has imposed an extra CRR or cash reserve ratio of 10% on the incremental deposits as of July 28 over May 19. That was, May 19 was the day when the 2,000 rupee notes were started to be withdrawn. The RBI said this was intended to remove the easy liquidity that banks had, which was created by the return of the 2,000 rupee notes. However, the net impact is banks can't lend over 1 trillion rupees, which is the CRR, and this has pushed up already near-term yields in the market. Now, the second hawkish element, or so it appears to be, is this 5.2% CPI forecast for the first quarter of next year, FY25, April, May, June of 2024. Now, the Reserve Bank's April monetary policy report prepared us for a number around 4.5%. So, is the RBI trying to push out rate cut expectation? How will interest rates and indeed economic growth pan out from here on? For all these questions, I have with me an elite panel, SBI Chairman Dinesh Khara, former MPC member and professor at IIM Kozhikode, Mr. Mridul Saggar, Samiran Chakraborty, the economist at Citi India, and Neeraj Gambhir of Axis Bank. Gentlemen, thank you very much indeed for joining me. Mr. Khara, I must start with you. There is a penal element in that 1 trillion rupees. Yours would be a lion's share of probably 25,000 crores. What does this mean? Would it mean a cut on margins for this quarter, or do you think you can pass on the cost?
I don't think that it will have very significant influence for us, because as it is, we were having excess liquidity also, as well as SLR also. Only thing is, maybe we'll have to probably realign our SLR and the CRR. Maybe, well, we might, actually I don't think so it will have very significant impact. Though we have worked out some cost, but that cost does not work out to be very significant. So I think maybe we'll try and see that how best we can live with that without making much of pass through.
Okay. More generally, the governor's statement was even-handed. It appears to have pushed out rate cut expectation, but I will come to the economists on that. But Mr. Khara, what is your sense about how lending rates will move from here on?
My sense is that this is likely to be a stable policy rate regime. This is my understanding, and which means that should not be much of increase in the deposit rates, and perhaps will not give, even the loan book also will have rather stable trajectory. This is what my expectation is.
Okay. Well, let me toss the questions to the economists and then come to Neeraj for how the markets have reacted. What's your sense, Samiran? Do you think that this 5.2% inflation for the last quarter for which he has given us data, April, May, June 2024, is a bit of an upside surprise?
So, Latha, if I may start this way, that in today's uncertain world, having any confidence on a 1 year ahead inflation forecast number is relatively low. We are all making broad assumptions about historical trends being repeated. to get into 1 year ahead inflation forecast. One aspect could be that RBI wanted to show that the current real policy rate is more like 130 basis points rather than saying that the number is closer to 200 basis points, which would have been the case if RBI had projected a 4.5% number for that quarter. So maybe from that perspective, it makes a more reason. The other aspect is that in that quarter, there is a little bit base effect also, which can potentially push this number slightly higher. So the bigger question to me is that whether RBI is prepared to act on the basis of these 1 year ahead inflation forecasts, or are the shocks becoming too frequent for RBI to actually wait for inflation to come down to a more reasonable number closer to 4% before they can think of the rate cut? I think that's the big debate that we need to have.
Well, actually, why don't I pose that question to the man who has been in the MPC's shoes? Mridul, what's your sense? Because as Samiran says, it's becoming a very difficult game to forecast because of these one-offs. So do you think the Reserve Bank in, say, April of 2024 will forecast a 4.5% later on in the year and have the courage to cut at all? Or will it just wait to see at least a 4.3 or a 4.5 number before it even ventures to cut?
So I think the rates, first point I'd like to make is that today's rates are not high. So the logic that we should be cutting from here is a bit premature. So I'm fine with holding the rates, but the case for cuts would have to be seen a year down the line. And as you see, the point you were making that 5.2 is a little high for Q1 of FY25. Actually, it's not so high either. I mean, if one was to see the fan charts of the RBI, there is considerable uncertainty about the inflation behavior. And that's the right thing to do because you are really projecting inflation. And if there is uncertainty, you have to acknowledge that uncertainty. So even when in April this 4.5 was delivered by the RBI in its monetary policy report, the Q4 number was 4.4, but the Q1 numbers were higher and the fan chart was trajecting down, and the confidence interval at a 50% level was between 3 and 5.8, and at 70% level it was 2.2 to 6.5. So not very comfortable at that point of time also. So it's the markets which are reading now that this number is high, but this is actually probably the right number to go by.
Okay, well, I actually painfully did the 5.2% for Q4 and the 5.2% rise for Q1 FY25, which RBI has forecast. And it still looks like RBI is factoring in a stronger momentum than we saw in the current year. So, I mean, there is a lot to believe that the Reserve Bank is somehow given a higher than expected number over there. Be that as it may, Neeraj,
Latha, if you allow me to clarify, I mean, the uncertainties in that point of time have gone up considerably. Yes. I mean, between these 2 months. Yeah. If you see the global food price cycle, which was actually the food prices were falling 2 months back. And today we have weather disruptions everywhere. Yeah. I mean, you look at China, for instance.
Those points are taken. All I'm saying is that the set of economists who believe that this is a little more than we were prepared for have a point, have some point at least arithmetically. That was a limited point I'm making. But Neeraj, is that what the market took home? We actually saw the yields fall, but near-term yields rise. So what has the market taken from the policy?
I think market was expecting a reasonably hawkish policy, which was reflected in the fact that the 10-year bond yield actually moved from almost 7% to 7.20, about thereabouts, in the run-up to policy, not just because of the policy, but a whole host of global factors as well. But in that sense, I think the policy has not been too much of a surprise. I do feel that incremental CRR was a bit of a surprise, but expected that some action was would have been taken by Reserve Bank given the fact that liquidity was consistently in surplus and the overnight rates were close to 6.25. And the fact that this is a short-term measure, so that also market has sort of discounted, and hence we are not seeing much of a impact on the long bond yields. Short-term rates have impacted because now the overnight will probably be more closer to the MSF rate, or at least reverse, at least rep rate.
Yeah.
Hence the short-term rates have actually inched up. But I think overall this was broadly on expected lines, except for the ICRR, event.
Okay, the ICRR, Mr. Khara, you had even a hint that they may come with this. It's almost a hammer of a stroke.
No hint. It's more like a surprise for us also.
Okay, a slightly nasty shock. But Mr. Khara, what is your sense in terms of whether it will go away on September 8th, which is the date given for review? The argument is that September 15th is advance tax payout, 20th would be GST payout, and September 19th is Ganesh Chaturthi. It really signifies the start of withdrawing cash. So, I mean, do you think it's a good guess to work with September 8th?
No, I think normally this is essentially to really address the excess liquidity in the system, and hopefully, normally during the busy season, there are more productive activities which require more and more funding. So I think it's a very reasonable guess that it might be revisited in September.
Okay. What's your sense, Samiran? Will it be revisited in September, you think?
It depends a lot on exactly what RBI is achieving through this. Okay. If it is only about liquidity management, then clearly there is a chance that it will get addressed in early September, or at least the 10% number could be lower to a 5% kind of number. But if it is more about trying to push banks towards getting into 14-day VRRR on a more permanent basis, then maybe it continues for a bit longer. But I would say that the chances of it getting revised is much higher.
Okay. Your thoughts, Neeraj?
No, I am hoping that they review this in early September, as they have mentioned. They said that September 8 or before. But it will all depend upon how liquidity plays out, and liquidity itself will depend upon what happens to FX flows, what happens to government spending, a whole host of other factors. Yep. But my expectation is that they will probably stick to what they have said.
Okay. Well, I want to know more about what you will make of growth and inflation in the economy. Those questions after a very quick break. We are back.